While the US has been busy with its own trade fights, Canada has been making smart moves in Europe. This isn't just about politics, it's about business. While Washington focused on tariffs and trade wars, Canada saw an opportunity and took it. Trudeau didn't go to Europe just for photos. He had a clear message: buy from Canada. This is a direct challenge to US suppliers in Europe. If Canada convinces NATO allies to switch their supply chains, it won't just mean more business for Canadian companies. It could change the balance of economic power across the Atlantic. The US didn't see this coming, and now the big question is Canada setting itself up as a real trade alternative to the US? At first, this might not seem like a big deal. Canada has always been friendly with both Europe and the US. But trade is about more than just friendships. It's about power. Right now, Canada is trying to become a bigger player in global trade. Trudeau and his team didn't just talk about policy in Europe, they came to make deals. Their message was simple: stop relying so much on US suppliers and choose Canada instead. Canada's pitch makes sense. It offers lower costs, fewer trade restrictions, and a more stable business relationship. The US, on the other hand, has been using tariffs and trade rules as political weapons. This has made European businesses nervous, and many are starting to see Canada as a better option. The foundation of this plan is CETA, the trade deal between Canada and the EU, which has been in place since 2017. Now, Canada is doubling down on it. Trade between Canada and the EU is already worth about $119 billion a year, but even a small shift away from US suppliers could have a huge impact. What's interesting is that this isn't just about Canada making a move. Europe is also looking for new options. The US has always been the top economic partner for its allies, but that position isn't guaranteed anymore. The world is changing, and European countries want to spread their trade risk. Canada gives them a way to do that without cutting ties with the US completely. So why now? The timing isn't random. The US has been increasing economic pressure, putting tariffs on both allies and rivals. Just recently, Washington announced a 25% tariff on EU car imports. This has made European businesses worried about getting stuck in a trade war. Now, many of them are looking at Canada as a safer, more stable partner. Canada is working hard to build a strong and stable trade reputation. Unlike the US, it is not imposing unexpected tariffs or using trade as a political tool. This makes Canada an appealing option for European businesses that want steady and predictable trade relationships. Another important factor is energy security. Europe has been trying to reduce its dependence on US energy exports, especially as global energy markets become more unstable. Canada has stepped in as a reliable alternative, offering natural gas and oil to European countries. With energy security becoming a major concern, this gives Canada a big advantage. But it's not just about energy. Canada is also expanding its role in manufacturing, aerospace, and technology, three industries where European companies are looking for dependable and competitive suppliers. This move is not only about trade, it's also about influence. If Canada strengthens its economic ties with Europe, it will gain more than just financial benefits. It will also increase its political power. For years, the US has used its economic strength to influence global politics, especially within NATO. But if NATO countries start shifting their trade partnerships to Canada, the US will lose some of its ability to control global trade decisions. And that's something Washington won't ignore. Right now, Canada is testing the waters. It is negotiating deals and seeing how willing European businesses are to shift away from US suppliers. If this strategy succeeds, it could lead to a major shift in transatlantic trade. Canada could move from being just a US trade partner to becoming a major global economic player. The US is keeping a close eye on this. If Canada starts gaining too much ground, Washington will have to decide whether to respond by offering better trade deals to keep European businesses or by pressuring Canada to step back. Either choice comes with risks. If the US pushes too hard, it might push European businesses further toward Canada. But if it does nothing, it could lose its influence over a key trade region. This is just the beginning, but it's part of a bigger trend. Canada is expanding its trade beyond the US, building stronger ties with Europe, Latin America, and Asia. It wants to make sure it's not too dependent on any one trading partner, not even Washington. If these new trade deals hold, Canada will have more power in future negotiations with the U.S. And if the U.S. responds with new tariffs or trade barriers, it could speed up a long-term shift, making Canada an even bigger force in global trade. One thing is clear, this isn't just business as usual. Canada is making a calculated move to become a major trade power, and whether the U.S. likes it or not, this shift is already happening. The real question is, will Canada's strategy succeed, or will the U.S. find a way to pull Europe back under its economic influence? Canada isn't just talking about trade policy, it's securing real economic wins. This isn't about press conferences or handshakes. It's about making sure Canada has a strong position in global trade. The message to Europe is clear. Canada isn't just a backup option. It's a serious alternative to U.S. suppliers. And this shift isn't just a possibility. It's already happening. The foundation of this strategy is CETA, the trade agreement between Canada and the EU, which has been in place since 2017. But now, Canada is pushing harder than ever to turn it into a real game changer. Since CETA was signed, trade between Canada and Europe has grown by 2/3, a massive increase that proves this deal isn't just symbolic. It's actively reshaping global trade. But this isn't just about numbers. It's about supply chains, economic influence, and long-term strategy. Right now, the U.S. dominates transatlantic trade and has been the main economic partner for NATO allies for decades. But Canada is challenging that dominance. Even if European businesses shift just a small portion of their supply chains from U.S. companies to Canadian ones, the economic impact could be huge. Billions of dollars could move away from the U.S. and into Canada's economy. And this isn't just a theory, it's already happening. European companies are actively looking for ways to reduce their dependence on U.S. suppliers, and Canada is providing a real alternative. This isn't just about avoiding U.S. tariffs and trade restrictions. It's about stability, predictability, and doing business with a country that doesn't constantly change its trade policies based on politics. The U.S. has been using trade as a political tool for years, targeting both allies and rivals with tariffs, sanctions, and restrictions whenever it suits its interests. Just recently, Washington announced a new 25% tariff on EU car imports, a direct hit to European industries. This move is forcing businesses to reconsider their reliance on U.S. trade, and many are now looking at Canada as a safer, more stable option. But this shift isn't just about tariffs, it's also about key industries. Canada is making a strong push in energy, manufacturing, aerospace, and technology, sectors where European businesses are searching for reliable and competitive partners. By positioning itself as a leader in these areas, Canada isn't just expanding its trade, it's securing long-term economic influence on the global stage. European businesses that once relied heavily on U.S. suppliers are now looking at Canada as a real alternative, and for good reason. One of the biggest factors driving this shift is energy security. Europe has been working to reduce its dependence on U.S. energy exports, especially as global energy markets become more unstable. In response, Canada has stepped up as a major supplier of natural gas and oil to European markets, and that's a big deal. Energy security isn't just about economics, it's about geopolitics. If Europe can rely on Canada for energy, it has one less reason to depend on the U.S. Then there's manufacturing. Canada has a strong industrial sector and is pushing to become a bigger player in European supply chains. In the past, European businesses often turned to U.S. suppliers for industrial goods, machinery, and aerospace components. But with increasing trade uncertainty surrounding the U.S., Canada is making its case as a more reliable and predictable alternative, and it's working. Take the example of Lindt and Sprüngli, one of the world's top chocolate producers. The Swiss company has already started adjusting its supply chains to reduce its exposure to U.S. tariffs. They are now looking at ways to source more from Canada to avoid the economic fallout of rising trade tensions between the U.S. and the EU. This may be just one example, but it reflects a much bigger trend. The big question now is, how far will this go? Will Canada manage to shift enough trade away from the U.S. to change the balance of power in transatlantic commerce? That's what Washington is trying to figure out. If Canada keeps securing deals and strengthening its trade relationships with Europe, it could reshape the entire economic landscape of NATO, and that directly challenges U.S. influence. The U.S. won't just sit back and let this happen. It has too much at stake. Washington now has a decision to make. Should it counter Canada's growing influence by offering better trade incentives to European allies? Or should it take a more aggressive approach and apply economic pressure on Canada to keep transatlantic supply chains centered around the U.S.? Either move carries risks. If the U.S. pushes too hard, it could drive even more European businesses toward Canada. But if it does nothing, Canada could solidify its position as a serious trade competitor, something Washington definitely wants to avoid. This also raises another important question. How does Canada see its relationship with the U.S. moving forward? The two countries have one of the closest economic partnerships in the world, but moments like this make it clear that Canada isn't just a junior partner anymore. It is actively working to ensure it isn't overly dependent on U.S. trade. And that makes sense. The U.S. has been using trade pressure tactics more frequently, and Canada has realized it can't afford to rely too much on one partner. But this isn't about cutting ties with the U.S. Far from it. Canada's goal is to have leverage. By strengthening its trade relationships with Europe and beyond, Canada is making sure it has options. And in the world of global trade, having options means having power. If Canada successfully positions itself as a strong economic partner for Europe, it gains significant leverage in future trade negotiations with the U.S. But this isn't just about Canada. Europe has its own interests at play. European leaders aren't making any sudden moves, but they're definitely paying attention to what Canada is offering. And there's a good reason for that. Right now, European businesses are prioritizing supply chain diversification. They've seen the risks of depending too much on a single supplier or trade partner, whether it was the disruptions caused by the pandemic or the unpredictability of U.S. trade policies. European companies want options, and Canada is giving them one. Energy security is another major factor. With global energy markets facing uncertainty, Canada is presenting itself as a stable and reliable alternative to U.S. suppliers. European leaders are taking this seriously, especially as they work to ensure long-term stability in their energy markets. There's also a political angle to consider. Strengthening trade ties with Canada doesn't just benefit businesses. It gives Europe more leverage in trade negotiations with both Washington and Beijing. By diversifying its trade relationships, Europe can negotiate from a stronger position, knowing it has alternatives to fall back on. The real question now is, how will Washington react? Will the U.S. try to reassert its dominance and make it harder for Canada to gain ground in Europe? Or will it have to accept that its influence over NATO's economic landscape is starting to weaken? One thing is clear. Washington is paying attention. The U.S. has always had a close but complicated relationship with Canada. While they share one of the strongest economic partnerships in the world, the U.S. has never hesitated to use its economic power to maintain control. For decades, the U.S. has dominated transatlantic trade, securing its place as the primary supplier for NATO allies. But Canada's latest moves are challenging that position. If European businesses shift even a small portion of their supply chains away from U.S. companies and toward Canadian alternatives, it could mean billions of dollars in lost revenue for American industries. More than that, it would weaken Washington's ability to use trade as a tool for global influence. The U.S. has built its economic power on the idea that its allies rely on it for stability, but now Canada is offering NATO nations a different choice, a stable and predictable trade partner that doesn't constantly shift its policies based on politics. That's a direct challenge to the way the U.S. has operated for years, and Washington knows it. So what happens next? The U.S. has two main options. It can fight back economically by making it harder for European businesses to switch to Canadian suppliers. Or it can pressure Canada into backing off, ensuring that transatlantic supply chains remain centered around American industries. Both approaches come with risks. If the U.S. takes the economic route, we could see new trade incentives aimed at keeping European businesses tied to American supply chains. That could mean tax breaks, lower tariffs, or exclusive trade agreements designed to make the U.S. the more attractive option. But there's a problem. The U.S. has been increasingly relying on trade restrictions and tariffs, and that unpredictability is exactly why European businesses are considering Canada in the first place. Take the recent U.S. decision to impose a 25% tariff on European automobile imports. Moves like this are forcing European companies to rethink their reliance on American trade policies. And as long as that uncertainty continues, Canada's pitch will only become more appealing. That decision sent shockwaves through the EU, forcing manufacturers to rethink how much they want to depend on American trade policies. If Washington continues to impose aggressive trade restrictions, it could actually push Europe closer to Canada instead of stopping the shift. Then there's the other option, direct pressure on Canada. The US might decide it doesn't want to risk losing influence over NATO's trade network and start making things harder for Canadian exports. This wouldn't be the first time. The US has previously slapped tariffs on Canadian steel and aluminum, and history could repeat itself. In fact, Washington recently doubled tariffs on Canadian steel and aluminum, raising them to 50%. That's not just a minor trade dispute. It's a clear signal that the US is willing to use economic pressure to keep Canada in check. But Canada isn't backing down. In response, Ontario suspended a 25% surcharge on electricity exports to the US, making it clear that it's ready to push back. This back-and-forth escalation is exactly why Canada is working to diversify its trade. Every time Washington tightens its grip, Canada realizes how risky it is to rely too heavily on the American market. That's why it's doubling down on trade deals with Europe, Latin America, and Asia. And it's not just Canada making these calculations. Europe is watching closely. EU leaders know that Washington has a history of using trade as a political tool, and that's why European businesses are hesitant to stay too dependent on American suppliers. Canada offers them a way to diversify without completely cutting ties with the US. This shift is already underway, and it raises an important question. Did Washington underestimate Canada? Some trade analysts believe US leaders didn't see this coming, while others think they were caught off guard by how aggressively Canada is moving. For years, Canada was seen as a close US partner that mostly aligned with American economic policies. But now, it's making it clear that it's willing to carve out its own path. This isn't just about one trade visit or a few deals. It's part of a much bigger strategy. By strengthening trade ties with Europe, Canada ensures that it's not fully dependent on the US market. By expanding energy exports, it positions itself as a global supplier, not just an American backup. And by pushing for supply chain diversification, Canada is reducing its reliance on any single trading partner. The US has always had leverage over Canada in trade negotiations, but if this shift continues, that leverage will weaken. Washington knows this, which is why its next move will be crucial. If the US is determined to maintain its dominance, it could try to make it harder for European businesses to work with Canada. That could mean new trade restrictions, higher tariffs, or even diplomatic pressure on NATO allies to steer them away from Canadian suppliers. The question now is, how far is Washington willing to go? If the US tries to stop Canada's rise in trade, it could backfire. Pushing too hard might drive European businesses closer to Canada instead of keeping them with the US. If that happens, the US could lose some of its long-time influence in transatlantic trade. But if the US does nothing, Canada could grow stronger. European businesses might start choosing Canadian suppliers, and new trade deals could make Canada a serious player in global trade. The US would still be important, but it wouldn't be the only dominant force in NATO's economy. Now, Washington has a decision to make. Should it see Canada as a competitor and try to stop its growth? Or should it accept Canada's rising influence and find a way to work together? This isn't just about trade, it's about power and alliances. Canada isn't just selling more goods, it's changing the balance of global trade. If this continues, the US may have to fight harder to stay in control. If Canada's strategy is just a short-term plan, it might slow down. But if it keeps gaining support, this could be a big shift in the global economy. The US won't ignore it, and at some point, it will make a move. Will Washington offer better deals to Europe to stay ahead? Will it pressure Canada to follow its trade rules? Or will it let Canada become a real competitor in the market?